On Monday, oil prices sharply dropped, with both major benchmarks plummeting over 2% to hit their lowest levels in 8 months. This steep decline highlights the ongoing tension in the market between fears of a recession and geopolitical pressures. These significant losses extend the bearish trend seen in recent weeks, with both contracts marking their fourth straight week of declines, the longest losing streak since November. The steep sell-off is mainly fueled by fears of a potential recession in the United States, the world's largest oil consumer. Weak economic data worldwide has heightened concerns about sluggish fuel demand. Last week's U.S. jobs report revealed fewer jobs added than anticipated, and manufacturing sectors in the U.S., China, and Europe continue to face significant challenges. Adding to the bearish sentiment is the slumping diesel consumption in China, the world's biggest contributor to oil demand growth. This weakness in Chinese demand is putting significant pressure on global oil prices, overshadowing other market factors. OPEC's recent decision to uphold its strategy of gradually ending voluntary output reductions starting in October has added additional pressure on prices. This decision suggests a forthcoming increase in supply later this year, despite the current market downturn. According to a Reuters survey, OPEC oil output increased in July, despite the group's ongoing production cuts. While Middle East tensions provide some support to oil prices, with ongoing conflicts in Gaza and the potential for regional escalation, these concerns have been insufficient to offset the broader economic worries driving the market. The short-term outlook for oil is notably bearish. Recession concerns, rising OPEC Plus production, and weak demand from China are expected to keep exerting downward pressure on prices. Traders should stay attentive to upcoming U.S. economic data and developments in the Middle East, but the current trend points to further price weakness in the near term. The oil market outlook appears bearish in the short term. Crude oil futures are in a freefall for a second straight session on Monday. The downside momentum suggests prices are headed toward $73, the June bottom that launched the eventual rally to $84. Prices are nearing value areas, but all we expect to see is a possible dead cat bounce. The true value often remains unclear until a support base starts to establish itself. Middle East tensions offer little support to oil markets, as traders are more concerned about potential demand weakness. However, WTI oil may find support in the $70-$73 range and might attempt a recovery from recent multi-week lows. Please like and comment to support the channel. See you in the next one.